So recording is starting. And what we usually do, of course, as you probably remember, William, is we wait till about 10:32, 10:33. There will be a few late comers. So we'll start bringing people in. And yeah, thank you in advance for your time and your input. I'm really looking forward to it. And I hope Con joins. I don't know if Con's down on the list, but it was quite a heated discussion. It's quite a heated discussion last week. It was. I think that you're talking. I think you're talking bollocks. So, oh, there's a bit of feedback. So that might be somebody might have to go on mute
I need to mute. Sorry.
Put your ears in, something like that. Yeah. So, okay, let's. We'll start admitting people, and we'll then get cracking. So, good morning, Andre. Good morning, John.
Morning.
Good morning, Peter. Good morning, Chris. We're just getting some other joiners coming in. As usual, if you could go on mute to allow William to speak, that would be fantastic if you've just recently joined. And we'll leave it another minute or two and just see who else. Henry, will mute you if that's all right, or can you mute yourself, Henry? That would be useful. Leaving William to speak, which would be good. So bring some more people in. So I'll run the lobby, William, and I think TC is going to help you with the slides. But good morning, John, as well. Good morning, Aaron, and good morning, Andre. So yeah, there'll probably be a few last minutes coming in. So I'll monitor the lobby there, William. We'll wait until 10:33. Just so everybody's aware, Miles, Andre, John, we're being recorded. We're recording at the moment, so thumbs up if you're happy with that, Miles and Andre, John. Everybody's happy being recorded, and I'll look at the lobby. So yes, good morning, everybody. Welcome to Coffee Morning on Tuesday, the 18th of October. The wonderful topic today is the long and the short of it, and I think we're delighted that William will be speaking and presenting a few of his comments and ideas. For those of you that were on the session last week, Dr. Con Keating did a great session on LDI, the wonderful world of DB schemes, the role of the investment advisors and all that sort of stuff, and the role of the regulator and the Bank of England. And I think we want to pick up on that later on as well with Henry. So, William, I will pass over to you. As I say, we are being recorded. If anybody, this is as usual in a formal session, if anybody wants to raise a hand during the session or whatever, then please raise a hand. It's informal. So over to you, William.
Great. Thanks, Steve. Well, the subject is the long and the short of it. Well, I think financial managers of UK defined pension schemes have messed up with leveraged LDI. And being a forced seller of liquid assets of material value to a scheme just has to be a major error. But of course, LDI was a symptom of short-termism and a fast-track journey to annuitize. So on the story of this morning a little bit is there is another way. Rather than race to the exit via LDI and annuitization, why not take a long-term view and run the scheme on? So what has LDI been helping us with? Well, I don't know if some of you may have noted over the last couple of years, we've been running a series FD Carroll animation. So our own FD Carroll obviously needed to come up with an animation for this morning. And this is the world premiere. Hope. So there we go. So obviously, that's one take on what LDI has or hasn't added to the sum of human happiness. But right now, it's about damage limitation, I suppose, as the immediate requirement. Obviously, then to be followed, as Con was probably getting at last week, why a steward's inquiry. And perhaps then the governance rules will ban it. Or if they go the whole hog with Con and John Ralph's kind of analysis, it will have been declared to be illegal anyway, which obviously will have its own ramifications. But obviously LDI has, and I'm sure in the future will continue to have, an important role to play. But taken too far or put into its leverage form, obviously it is proving problematic. So what makes us think that leveraged LDI, however, is the only sleeper problem? I think the short of it is that short-termism of get rid ASAP, as we christen it, as a strategy has other difficulties. And we'd like to touch on those and then perhaps more positively look at the long of it, which is run on long term. Now, I've been involved in corporates and their pension schemes alarmingly since the mid-1980s. And over that time, most corporates have disengaged. Leave it up to us has become the attitude of trustees and their pension consultant friends. Now, I don't think either of those trends has really helped anybody. The DB industry has ended up as a bubble, believing its remit is to close itself down as soon as possible by striving for the gold standard of annuitization. And in so doing, as we've been examining over the last couple of weeks, it has created some new systemic risks. Ironic it is indeed for the FT's Lex column to be saying that the Bank of England's role was not to keep the long end gilt yields up to oblige pension schemes with what it called their ill-judged derivative bets. Bets by the pensions industry? How do we get here? Well, clever investment bankers, I remember very well, set up new lucrative pitches 15 years ago in pensions land. They devised journey plans with great relish, but there were two snaggets. Any FD of a corporate or liquidity constraints knows that the calls for interest or exchange rate collateral calls do cause anxiety, something I think probably an awful lot of trustees are now familiar with. And of course, well, the leverage that comes with repos to cover a theoretical actuarial calculation, well, that doesn't need the cold light of day to work out that's a worry. But the second issue for LDI is that it is, as Con pointed out right at the beginning, hedging the measure, not the cash. So now, here's one for you to all consider. What if Solvency II's replacement produces a new basket of assets to back insurers' capital weightings? Now, clearly, I think we've discovered that the gilts market is not quite as liquid as believed. So, as with RPI, CPI, the industry could have left itself hedging the wrong thing. So, in summary, I would say, elevating actuarial pounds above actual pounds was a truly bad idea for pension scheme members. But the triumph of de-risking was not just with a few LDI derivatives. It blossomed into the risk transfer industry with the plausible, smooth-talking sales force shepherding anxious trustees to buyouts and buy-ins. Corporate sponsors just became cash cows in those consultants' business models. They convinced corporates that pension schemes are dangerously volatile and only exiting will enable the board to focus on their true business calling of widget making. And of course, the industry has been brilliant in capturing language, risky, gambling, roulette, return seeking. That contrasts so nicely with peace of mind, matching, fiduciary duties. All those words help reinforce the case for risk transfer. I would argue now, though, that the gold standard approach, like that of the gold standard in the 1920s, really is rather flawed and ill-timed. With Solvency II's replacement not yet clear, that once in a generation change, which the regulator suggested was coming, is not yet clear. And so, if it's not clear, how can the value in it be judged? And one thing I particularly think is particularly interesting, when mortality tables using the pricing, well, they're all set, I think, to get revised downwards quite significantly. So again, prudence, that long forgotten concept, well, she would have to argue that above all else, wait and see should be the right tactic. Now, we're not for a minute arguing that life insurers do not provide good, appropriate in many cases, buyout solutions for many schemes. But the life insurance market does have maybe some underappreciated characteristics, which I think are relevant. The last year, 90% of the market was with just 5 participants, all of whom appears to be terrifically impressive in profitability terms. So that much vaunted competitive market, I don't see it. No, the consulting industry has its cheerleaders and plenty of easy targets. Reform may, of course, open up that market, but don't undertake a buyout now, is our argument, for fear of being at the wrong end of a long queue. But look at those concentration risks, financially in systems terms, of those few schemes which are going to be picking up so much new business. It is interesting again to consider, if an insurer actually did go down, would the financial services compensation scheme bail it out when a lot of the risks have been reinsured outside of Solvency II? I think that's the sort of subject which the Bank of England in their steward's inquiry will be looking into. Of course, the first question in pensions is what's in members' best interests? Obviously, the accrued benefits to be paid. And the downside risk of non-payment of that pension, what happens if the sponsor disappears? Well, of course, there is the safety net of the there is for the insurance market, the unfunded, untested financial services compensation scheme. And that is clearly better than the well-run, well-funded pension protection fund. But how much better? Well, I find it remarkable. The industry has almost like a self-denying ordinance of actually doing the sums to highlight what the differences are. So, are there any upsides for staying outside the financial services compensation scheme cover? Well, they're very real when inflation is 10% and insurers cap. Indeed, most company trusts are capped at 5%. Well, even if many schemes are in surplus, there is still a very marked reluctance that I think Henry's been pointing out to look at the subject of discretionary increases. I think that should still, after LDI, pre-LDI, should be on the agenda. Members are treated, I think, to too many pious statements because they're not actually engaged enough. But I think that could change. When you look at the hitherto, I'd say, DC-focused Make My Money Matter, and you're finding it running full-page adverts aimed at directors in the FT about weak ESG credentials of big pension schemes, there is, I think, a straw in the wind. I think change is coming. I think you will see more member activism and enthusiasm for looking at what pensions they're receiving. And that all brings us to maybe the key punchline of the long run approach. Corporates embracing their pension schemes again. Perhaps the LDI crisis does mean that corporates get more stuck in, something we've advocated since we were formed 5 or 6 years ago now, with pension provision that just having those fights over triennial valuations and the check requests. Well, that's not really enough to suggest the corporates are really engaged. Boards, I think, are sometimes caricatured by pensions consultants as not being interested in pensions because they don't have any skin in the game. Well, maybe that's the case, but what is needed really to get boardroom engagement, and having been a boardroom member for over 25 years, I can tell you it really is about financial and reputational upsides. And attitudes do change. And if the industry is really working for members, it should wake up to the new possibilities. Suddenly, pension strategies of de-risking, I think, are starting to look a little bit dated. Where can you see that happening? Well, read the corporate accounts and their ESG statements of corporates. They are the chair, the chief executive, not just the finance director, absolutely explicit about working for the better world and that their colleagues and staff are being their biggest assets. Actually, quite often there's pages on the subject. These statements need backup and real life examples because greenwashing is also a big issue. Pension asset allocation and pensions of yesterday's and today's employees is a complete worked example for many corporates of their ethos in action. That makes it singularly attractive for corporates to look again at how they treat their pension funding. Pension provision rose, remember, out of the need to have a loyal staff ready to stick with the employer. What a great chance there is now to come back to that subject. So far from severing the link between corporates and the schemes, our idea very much should be to reinforce it and enable the scheme and its sponsor and its members all to be serving all stakeholders. So as the funding position of schemes has improved, where possible, corporates should provide, in our business model, third-party risk diversifying guarantees to ensure the scheme is always at low dependency. And should it fail, it can still meet its obligation through those guarantee payments. Banks and insurers are frustrated, we've found, that they are not asked to make bigger input into pension funding. Of course, most larger sponsors and their related schemes could provide those guarantees if they saw that extra purpose in it. So in exchange for sound long-term asset allocation, can be in exchange for having those guarantees, you can look to have long-term asset allocations put in place, expected to be there for, let's say, 10 years plus. That's what we call fiduciary plus. And then the trustees can work with integrated risk management committees around some set parameters in their statements of funding and investment principles. So as part of the new settlement, the trust deed and rules should deal with the upside when the scheme is in sustainable low dependency. Those stable returns above the discount rate and with the actuarial prudence coming through, with demographic assumptions proving, as they should be, actuarially prudent, there will be cash surpluses. So we think schemes in 2022 should not be making assumptions about how many members are married, their health, or partners that they have, partners' pensions. That should all be detail. And that real detail should calibrate actuarial prudence. And that in turn should produce extra cash being generated that can be allocated. Allocated to whom, I hear you say. That's the subject, I think, for today, not for tomorrow. It is part of the new all parties package. The agreement should be for upside for members on a discretionary, even on a one-off basis, and for funding for today's employees. That is not about adding to the tPR's fears about dividends, but improving pensions for today's employees by recycling surpluses as the founders of many of these schemes factored in many years ago rather effectively. So we think schemes should look to restart with collective DC or just DC tiers, where surpluses in the DB tier can be reallocated. Suddenly, HR is back in pensions land. So that's the long and the short of it. Financial managers, I think you can't get away from it, seeing what's happened in the last few weeks, have messed up. We think the risk transfer industry needs an away day or two. The consequences, once the damage has been assessed, can then be, yes, sure, we will have two ways of looking at things. You can either run on or you can de-risk and annuitize, because that will remain perfectly sensible long-term solution for a number of schemes. But more excitingly, I think sponsors should re-engage and see that all stakeholders are much better off if there is some well-applied contingent backup provided by them that enables the scheme to play long. Of course, the tPR can then see this as all giving substance to its bespoke solutions, so major schemes can carry on with confidence and with renewed purpose. And the tPR can then maybe focus on the weaker brethren. DB members, I think, at the same time should look at their pensions not as the done deal, but as something where, in terms of both control, and increasingly people are interested in the environmental issues around their pensions, but also look at them, at those schemes, as why can't they provide an upside? Altogether, it should mean they want to be more involved. So schemes should focus on being up to speed. This is something we think very strongly, up to speed with their data. Not enough money's been put into looking at the core data and what liabilities really exist. So that's really our case. We think the trustees and their advisors in current circumstances should indeed be now asking some awkward questions. We've actually written some. If trustees or the members, or indeed the sponsors, think that the events of the last few weeks do warrant some punchy questions with hopefully not glossed over answers. But of course, our own FD Carol Animation's been posing such questions for a couple of years. Obviously, we've seen what she thinks of LDI. Now you might have a look and see how we think you can turn what has long been considered the black hole of pensions. Well, maybe, after all, it's a magic money tree. Here we go. There we go. That's the plan. We think can hopefully produce better outcomes for more people, and maybe the fact there's been so much problem for so many people in the last few weeks might just be a bit of an opportunity for a review of what the options are. And I've thought for many years that a long-term answer, as well as the rush to the exit, they should be both available solutions, but not enough work has been maybe done by the industry in looking long-term as opposed to short-term. So it's not that difficult. And the kind of things we're talking about, we like to say, are very doable because it's not new technology. This is not asking people to go wait for months or pay loads of costs while new rules come in. This is something you can do now if you are so inclined. That's
William,
yeah.
thank you very much. That's really, really interesting. I'm conscious that there was some, very good content. One or two criticisms maybe of the consultant and advisory community. And we've got John and Chris both on the call. So we've got representations from Mercer and LCP. Do we think that criticism is just? Do we think the criticism is fair? And what have you guys been doing in the last week or three with this crisis, I guess, is the question. Maybe John or Chris, one of you could give your thoughts.
Yeah, sure. I'm happy to go first. I mean, what we've been doing the last 2 weeks is sort of most frantic 2 weeks I've probably seen, particularly on the investment side. A lot of that is in finding the collateral to meet the calls, for the reasons you've said. A lot a lot of companies are quite willing to very quickly put in place liquidity through either fairly simple loans or revolving credit facilities. And one of the banks I advise, they both did this for their own scheme and also started doing it for other people's schemes. So that was sort of an interesting development over the last few weeks. And actually, it was something that we were talking to clients about a couple of years ago, but actually wasn't much interest in it back then. But all of a sudden, there's dozens now that got done within the space of a week or just over a week. I mean, the approach more generally, I mean, my sort of role within Mercer, I'm part of the risk transfer team, but I actually advise in the more sort of alternative non-standard space, so closer to what you're actually talking about, William, in terms of what you're doing. I mean, the third-party guarantees, I think, as a way to get a good long-term outcome, I'm actually quite supportive of. I think there are some schemes where that works really well. Interested in your thoughts on which companies and schemes you think that works for. And in a way, it's sort of how far down the credit spectrum do you see that working for? I think you're muted, William.
He was.
You're not muted.
No,
Oh no, I can hear you.
We can hear you now.
Yeah.
We can hear you now.
Okay, that's
Yeah,
good.
yeah,
No, I
there
was going to say that was very good. But clearly, the problem has been is what you've done with clients of putting loans in place or facilities in place. You know, the losses here are really not about LDI per se, isn't it? It's all about being a forced seller. You know, if you're a forced seller, there's no excuse. If you can avoid that, then that's just hedging. That's what it's the nature of it. I think who the kind of things we're talking about most, odd sort of way, I would say the people that really should be doing the kind of things we're talking about are schemes which pass the gateway test for, let's say, for the super funds or this sort of stuff that was dreamed up. If you can get to buy out, the question is, should you? Because you could use what we're suggesting and the guarantees, you probably almost certainly have the financial capability of doing it. So the answer to your question is the stronger schemes are the ones that should be looking at doing this. There is a genuine option. Do I want to carry on and use it for all the reasons we're saying about making it more holistic approach to things, as opposed is those who could get out and have a genuine option, I think should be looking at whether this is the right thing for them. And then when you look at it from the regulator's point of view, at the point we were trying to make about how few, really, there are very few people in the life insurance market at the moment, and you're driving everybody to such a narrow fork in the road. You know, is that really, that feels kind of risky to me. I think why are you not encouraging big international groups who happen to have UK subsidiaries to stay? You know, why the industry hasn't found a way of utilizing the balance sheet strength of a lot of these corporates. It just doesn't, you know, I've always found it frustrating looking at numbers for 25 years. Why good, strong balance sheets of corporates aren't utilized better? It somehow just became, oh gosh, it's so volatile, it's so risky. No, it's not really very risky. And if you structure in a benefit to the members and to the sponsor of running on, they will. So it's maybe hasn't. So the answer to the question is, yeah, the further down the spectrum you go, if you're going to, certainly all the kind of guarantees we're looking at, as soon as you go below investment grade, triple B, whatever, then it gets more problematic. And then you're into some more complexity. How's that going to work? Yeah, there's a different game on there. But what is not being picked up is just how attractive it should be. And we know from lots of conversations now with the insurers and the banks, they wouldn't have any problem in providing the level of the guarantees that would be transformational for a lot of members of a lot of pension schemes and their sponsors.
What's that's good. Good answer, I think, there, William. John, are you happy with that, or?
Yeah. Like I say, you know, I think it's sort of unfair to group consultants all into one bucket because there's a range of views within any consultancy. I do appreciate sort of there is large risk transfer units, you know, and Mercer's got one of those. I think LCP's got one of the others, the other person on the call. you know, so and there is a big push for that. I mean, in part, I think the driver for it at an industry level is the fact that the regulators made things harder and harder, more and more expensive. The accounting standards haven't helped because it's really put the volatility into focus. And you put all of those things together, and your choices, particularly at the moment, given what's happened to rates, and schemes are close to buyout now, much more than they were. Buyout pricing has improved, at least relative to some measures. So schemes are closer, and you give the FD the choice. Like, I can come up with this plan. It will make lots of value for the company and the stakeholders over a long period of time. But the FD's, you know, time horizon is a lot shorter than the time horizon you're talking about. So you do have this sort of agency issue.
No, they're really, really good points. I would say there is a mindset problem at a corporate level. You know, my 25 years on corporate boards, you know, people don't want to talk about pensions.
No.
It's no glory that way. It's a pain in the neck. You know, but congratulate the finance director when he comes back or she comes back saying it's all finished. Yeah, what I think is different now, I think the ESG kind of stuff makes a big difference. If you're the chair, as we're talking to one big American company, where you're the chair or the and chief exec in that case of a company which actually has said we want to build a better planet, you know, why is your UK pension scheme transferring that over to a middle-sized, you know, life insurer on a buy-in? Why? You know, why don't you utilize that better? And it's if you purely left with the finance departments, and they will probably carry on down the route everybody's become used to. It's the engagement from the top. It's that people, you know, I was chief exec for a long time, and it's different from being the finance director. You need the chair, the chief exec, to say, actually, this fits with our ethos. We are trying to look after our staff. HR matters to us. Recruitment, retention, these are big issues, competitive advantages through having a pension scheme. You know, you've got to read back 30, 40 years to find out, why did people have these pension schemes? We spent all this time getting rid of them. Well, actually, they did serve a really important purpose. And do you need to chuck that out for what? You know, you know, I love all the people at PIC, but bloody hell, look at how profitable it is. You know, there's a lot of value in pension schemes. And as we all know, you know, with longevity and all this, there's plenty of upside. So I think it is an education job. I think there's an assumption, almost as I said in my little piece about a caricature of corporate attitudes. They do need to change if the sort of general drift to buyout isn't going to just continue.
Okay, thanks for that, William. Chris, do you want to sort of, what's LCP's view and what have you been doing? Oh, I don't know if you know John or whatever. John meet Chris, Chris meet John. Anyway, there we go. So.
Hi, John. Yeah. I shouldn't really be LCP spokesman because I left just over a week ago, but I know what they're doing in terms of so yeah, I now work at ATS actuarial, but yeah, I agree with everything that's been said, but and there was definitely a mix of people who wanted to think long term and short term. The problem was the short term people kind of always tended to win because Section 75 debt sort of says the deficit is the buyout deficit, and that's what it is. And the regulator encourages you to sort of have that covered at any point along the journey. And it's very hard to think long term when at every point in the journey, your combination of covenant and pension scheme assets has to meet that. And yeah, I think what was missing was an incentive for not so much the company, but the trustees to sort of think longer than that, to sort of bear that risk and to see the benefit to members of less money going into the pension scheme or directly into the pension scheme, but being used to, I mean, they're all closed now, pretty much, aren't they? So but using that money to benefit the new members, the members who are earning now, and I mean, I agree. There's a lot of benefits in there in terms of sort of closing the gender pensions gap and all that sort of stuff. Using the money well for a new scheme, perhaps a collective defined contribution scheme. But it was, I think people have found it a struggle to find the incentives for trustees to not just lock down and bleed the company for as much money as they can to protect the benefits.
think it's really, really punchy point. LCP I find fascinating because obviously there's you can see from the kind of comments coming out there is a split decision on what you should be doing, which is very interesting. But I think basically it's a question of the trustees themselves actually taking a slightly more wider view. And if you set your barrier pretty low as just I've just got to deliver the accrued benefits, and you don't see any wider picture, then you get to one conclusion. But here now, with inflation now over 5%, all this sort of stuff, there are other things, there are other factors, and yeah, the confrontational approach, which has obviously been very much to the fore the last 15 years. I can almost remember that with my good friends at WTW, the actuaries at one time were really, you could trust them to take a rounded view. And so I'm not picking on them particularly, but because the game just changed, that where actually it did become controversial. It became, the regulator was encouraging. If you couldn't show blood on the carpet after an actuarial valuation, that wasn't good enough. It did mean that it made it much more difficult for actuaries to just say what is taking all factors into account in people's best interests. And that's really what we're trying to get to. If this corporate would get a bit more involved, provide the downside risk cover, which trustees ought to expect. I don't see why this. I don't really, truth be told, I don't see why the trustees have to do so much work on covenant. If you're a good enough covenant, the people who know most are the insurers and the banks. So get them to provide some backup, and once you've got that, then you can have a really strong case to play long. And the issue then that does become, to answer your question about benefits, yeah, you should be looking at discretionary increases. You should be looking at what circumstances they were coming. There's a whole section, I think, missing in trustee and rules between accrued benefits and wind up. Why isn't there, if you've got extra money, yeah, I don't think the corporate should be taking it out. I think it should be recycling it for today's people. That's just my opinion. But at the same time, there's a lot more that could be done within the framework that's been established over so many years, rather than just saying decommissioning, get out, I wish we'd never started kind of culture is ridiculous. There, in many ways, you can argue what's happened in the UK with well-funded DB schemes. Well, that's a competitive advantage right now. It's a question of how do you use it to best effect.
Agreed. Yeah, absolutely. Con, I know you presented last week. What do you think of this sort of U-turn, and what do you think the impact will be on the trajectory on this sort of LDI problem? What's your view, Con, on the recent changes with the new Chancellor? I don't know if Con can hear me. Can you hear me, Con? Maybe he's gone out. I don't know. Are you there, Con? No, maybe not. Okay, Henry, what do you think? Bank of England regulator, that sort of stuff?
Yeah, it was a sort of the key word at the moment seems to be waterfall. So I'll talk about the waterfall of the regulators, if you like. Yeah. Yeah. At the very top, the number one regulator is the government. Yeah, they should be regulating the economic situation properly, and they obviously didn't have a clue what they were doing. Otherwise, they'd have taken into account the economic consequences. They'd have listened to the OBR, and we would have had a properly regulated mini budget. So that went wrong. The Bank of England clearly didn't know the impact that all this stuff would have on pension schemes, because it relied on people like Cardano and others to come and tell them that there was a potential problem with these pooled funds, and indeed with the segregated funds, and that was going to lead to systemic risk. And Bailey pulled the plug and said, OK, we'll pull the plug on QT and move to QE again, so we don't have that systemic risk. So that was a kind of like last minute adjustment, lastminute.com. Then we have the problems with the DWP, who've got their consultation finishing yesterday. Yeah, a consultation which basically drives schemes into the sort of short-term positions that John and Chris have been discussing. And we really need to wonder how this waterfall information is going to impact on them. And then we have, of course, the pension regulator and Charles Council speaking at the PLSA last week saying nothing going on here. We've gone and done our little bit of work and everyone in the garden is playing happily with no worries at all. Well, I mean, I'm married to a woman who is the CEO of a pension scheme with what used to be about £48 billion worth of assets. It doesn't have those assets anymore. A lot of them are in synthetic equities, it's true. A lot of them are in synthetic gilt still because the hedge is held. But the reality is that for the big growth agenda which the government wants, this is an organisation that holds very little assets and an awful lot of cash. And that does not seem to be the purpose of a pension scheme at any of the levels of the regulators. And the final level of regulation, which is important here, is the regulation of pooled funds and the liquidity of those funds. And that's an FCA stroke PRA situation, which I think has been completely missed, partly because the pooled funds all appear to be in Dublin and other places. And most of the reinsurance is going on in Bermuda or whatever. So it's outside of the regulatory perimeter, but also because the FCA really don't know very much about pensions. And there seems to be the usual problem between tPR and FCA, where one hand does not know what the other hand is doing. So if I'm looking at the regulatory waterfall right now, I'm looking at systemic failure from the top government right the way through to the very bottom, which is the retail regulation of funds. Yeah, and I see problems at all those levels. And where there's a problem, there's usually an opportunity, because we can move into front foot mode. I've noticed that there's already a letter that's gone to the pensions minister from William talking about solutions to these problems. I mean, that's excellent. I think that we can all move to a situation where we can talk up the opportunity that this gives to reconnect pension schemes with their boards, yeah, with their, not just their trustee boards, but with their executive boards of the sponsoring companies. And we can use this ESG lever, which is such a powerful one, to actually make change happen. My money does matter. You know, I'm a consumer, I'm a pensioner. My money matters, and I don't want to see my pension scheme being shunted off to a PIC or a Rothsay or whatever, yeah, as it is very likely to be. And if it is shoved off there, I want to make damn sure that I get the value of the surplus, but that's another matter. The most important thing right now is we say, hey, yeah, this is the rain check we need. This is the opportunity we've got. Let's make sure that we don't carry on down this crazy route towards everything being short term, everything being in the interest of buyout, everything being fast tracked to oblivion. Not the way to go. So end of rants.
A good rant, Henry. William, what's your response to Henry's rant?
Henry is right at the top of ranters. He's the best. In terms of putting, and I think there's an awful lot of opportunity. Well, an awful lot's going to change off the back of this. I do think that the regulator, as we've seen before, when there has been major problems, whether it was with Carillion or before that, right back to Maxwell, you know, the stewards inquiries can do an awful lot of, well, has a big impact, sometimes for good and ill. And I think that probably puts everybody on notice that when it comes, you need, this is a big opportunity, as Henry highlights, to make sure things head in a maybe a slightly different direction. And I don't think anybody should be squeamish about putting some new thoughts forward. I think why I'm quite excited about some of the things we've been saying, that it does, all the things we're saying do lend themselves to government policy. So we're trying very clear, we don't want to be trying to run a different direction to what the government wants. The government wants more money invested in the UK economy in one form or another. Various of the regimes the last year, of which there have been plenty, have broadly been consistent in impact investment counts. They want to do more of that. Place-based investment counts. Well, if pension schemes only think they've got to get out of here, then they're not really attuned to that agenda. So I think you can connect what they're saying here with government policy in quite an attractive kind of way for government. And, you know, obviously Solvency II is up for grabs too, how that can apply. Well, odd sort of way, you could say what we're suggesting is helps those Solvency II conversation, because it's almost like disintermediate. You know, you don't need to go via the insurer to get long-term investments if you can persuade major corporates, water companies through to international groups, to have long-term investment strategies which enable them to have more infrastructure, more green investments, or just, it doesn't need to be a large proportion of the thing, but you know, it could be green bonds. All those sorts of things are much easier to say should be on pension scheme agendas if the trustees feel their downside risk is covered. So I think if you go back to me, where the key turning point in pensions history really was ACT abolition. At that point, you actually had a subsidy effectively for the scheme. Why can't the government actually come out, instead of saying the only way is get out of here? We'd be delighted if you want to stay because you hit some of these targets, and even incentivize people to do it. Yeah. So, you know, it's back to what I said. These aren't terribly difficult issues, but it does need a mindset change from the corporates, maybe a bit from government too. But I think, you know, as I think we've been highlighting, different bits of the government have got different views. You know, almost you can sit around for a few days and you think that it would not take a lot to change corporate attitudes and you get them to play longer term, and made even government to say, actually, there's an awful lot of money here, a few tweaks to the way we're regulating things, and it's not all a disaster. What we've achieved in the last 20 years through the tPR and PPF isn't a disaster. We've set a perfectly sensible framework. We just need to go off in a slightly new direction. You know, there's no point in, I think Steve Webb was highlighting, there's a grave danger of the regulation is solving last year's problem. You know, it needs to look forward, and there's plenty of good stuff that could be added in, and the industry could help get added into government thinking.
Yeah. William, just coming back to the tPR, maybe question for you or Henry. Do you think there's a call for the regulator to consider regulating LDI? Do you agree or disagree with that? Henry, do you want to go?
I mean, okay, regulating LDI, the pension regulator should have a mind to the solvency of every scheme that it looks after, because that's what its duty is, to protect the PPF. If there are systemic problems in the pensions industry, then yeah, of course, LDI comes into it. Now, you know, we have a situation where we just don't know what the LDI positions that a lot of small companies have. I spoke to a lot of companies up in Liverpool, and they said they didn't know whether they had any money left in their LDI funds. I mean, that really is a crazy situation for the regulator and for the schemes. So there has to be a better grasp of what's going on than what we had last week and probably still have today. But consultants are there to try and help, and I know they do help, and I'd be more interested in their views than mine. So, you know, yes, I mean, pension regulator should be more on top of the situation. How? Well, I think I'd be more interested in other people's view than mine.
Okay. John Gethin, do you want to just quickly come back and, you know, have you had any of your clients at corporate or trustee level say, what the hell are the regulator doing with this, and why are we in this situation? Have you had any feedback?
Not really. I think most trustees were quite aware that if interest rates moved a lot, there were collateral calls. I don't think that surprised them. Clearly, the scale of the interest rate moves and what that then meant, and having the operational infrastructure in place to do it, that was a challenge for lots of schemes. Personally, I tend to work on the larger schemes. They all had segregated mandates. That generally was less of a problem. It was generally at the smaller end where there were pooled funds. You know, and I have heard some sort of horror cases, to be honest, where, you know, the trustees essentially were asked for collateral. They thought the equities were a bit low, so they didn't want to sell them. They let the hedge wind down. Bank of England steps in and they missed the rate fall. And it was just like horror story after the other over the last couple of weeks for them. But for the most part, most schemes I'm aware of kept the hedges on where they were through, like I say, company loans in some cases, sale of liquid assets in others. Most weren't running at such high levels of leverage that it was crippling. It was obviously a very tough period. Then, you know, looking forwards, the level of leverage you can run within pooled LDI has come down massively. The managers aren't running it anywhere near the level they were running at, given the current, well, I'm not sure if this is long term or given the current volatility, but there's just, I don't know what the multiples come down by, but broadly speaking, where on the segregated mandates I've seen, schemes are holding collateral for about a 300 basis point move in rates, with liquid assets to back another 100 bips. So that is, you know, if it went from here up another 400 bips, then they'd have to unwind it. But that's hopefully a bit of a stretch.
Okay, cheers, John. Appreciate that. Con, you've got your hand up, and glad to see you. Hope you're well.
I am indeed. You asked the question, my view on the U-turn on the budget. It's welcome in as far as it went, though they are still running shy of the obvious method of financing subsidy for individuals' electricity and gas costs, which is a windfall tax on producers. As it happens, I am a producer of electricity. We have 4 windmills in Shetland. This year they're going to generate us £550,000 in revenues versus a normal 210. That gain is pure windfall and should be taxed. I mean, it will be taxed anyway because we pay income taxes, but the gain itself should be taxed. The important thing to understand about the U-turn is it will not resolve the problem that we had. Trust and confidence in this government has been broken, and it will take years, if not decades, to restore that. So there is no way we go back to where we were the day before Kwasi Kwarteng spoke. I'll also add a thing on the regulation of LDI. LDI only exists because we have a mark-to-market accounting standard. That is fundamentally flawed, something I have been saying long before LDI started. I actually walked away from the Accounting Standards Board in the late 90s because I could not get them to see reason or sense. They believe in a financial economics model, which is no more than a theory, an unproven theory. If we correct the accounting, the motivation for doing LDI falls away. There's a further set of problems with LDI, which is that most of the actions that are taking place within LDI are actually illegal. They are prohibited by one or other piece of legislation. We've written extensively on this. I suggest you read it because I think that this is now becoming known by the regulators in Parliament and other places. The regulator really has a hell of a lot to answer for. If we were to implement the laws as they exist properly, which is actually tPR's job, then LDI as we know it would not exist. You would be buying liability covering assets within your investment portfolio. You would not be using repo or derivatives. They are forbidden. If we simply enforce the law, then we have no need for regulation of LDI, because the leverage aspect, which resulted in collateral calls on schemes could not arise. Okay.
So you had the crystal ball, Con, and they just didn't listen, basically, did they? That's the material point.
Well, we said that there were lots of problems. We knew that a spiral such as the one we saw was feasible. Ian and I just thought it was most unlikely.
Yeah.
Yeah,
Okay.
sorry.
I appreciate that. Yeah. John, you got your hand raised, John. Sorry. Yeah. John,
Yeah.
you go. Then Henry can come in. Sorry, go on.
Yeah, thanks. So to the first point was just around the accounting. I fully agree with that. I mean, the accounting is a sort of a nonsense number, and actually, where companies have really big schemes, even the like credit raters and analysts think it's a nonsense number. They back it out and they look at what's the actual funding or deficit numbers, or and they use that for assessing companies. Now that applies to a minority. Most they actually use the accounting numbers because it's they just sort of accept the error, which is a slightly bizarre situation. Even to the extent that sometimes they take accounting surplus in one scheme, accounting deficit in another, and they offset them when they're looking at the financials, which again is just like crazy. So I agree with that. I mean, much more sensible is to look at the actual sort of funding approach, assuming the funding is on some reflects the way that you've invested rather than a gilts plus fixed margin, which is the current consultation seems to be driving us towards. The second point was more actually a question, and I do fully get the scheme can't borrow, repo and LDI is borrowing to the extent you've got leverage. It is borrowing, and I don't think there's any doubt about it personally. It definitely is. And from a rates perspective, I fully get that. I'm sort of curious on your thoughts as to the same logic on inflation, because to the extent that you're hedging inflation with physical assets, there aren't really many out there. So therefore, if you're looking, and inflation, I think, is a genuine risk rather than the rates, which is just sort of perception, a mark-to-market risk. But if you're looking to actually hedge inflation, there aren't many options unless you start going into derivatives to sort of hedge that. So I'm sort of curious on your thoughts on that.
Could we? I'm very happy to answer, but I'm acutely aware that I'm not the speaker at this. It's William who is.
But why don't you give a strong, firm answer like you usually do, Con, and then we'll pass back to William.
Inflation. Yes, we should be doing things to hedge it. There is nothing wrong with buying index-linked bonds, other than for the fact that they are extremely volatile, and that the payoff over most of history has been grossly inadequate. So what one should be buying is things like the utility inflation-linked securities. And, if we were to start buying them in a meaningful way, rather than trying to use derivatives to do the job, which is simply not allowed, then we would find that there was a much larger non-government market for inflation-linked securities. The investment bankers are not slow to see an opportunity.
Indeed not. Indeed not. Okay, William. So back to you.
Yeah, no, I think again all good point. If anything, having been on a board to say for a long time, I'm just a smidge more not relaxed. I think about the accounting. I think the gap between the actuarial and the accounting techniques was a disaster. Basically, so you end up the accounts, as people have rightly saying, have become almost irrelevant. For a long time, they're almost like irrelevant because the real numbers were in the actuarial numbers, which weren't only just about in the accounts. So that was a basic problem. I think, if anything, if I was choosing an accounting standard, I think the US accounting standards are actually much better than the UK accounting standards, where you actually do include effectively a return on assets, which actually again gives corporates a bit of a reason to stick with pension schemes. So I don't think we've helped ourselves with the regulation, I think, at all. It is at the beginning of the decade, beginning of the century, pension schemes weren't on the balance sheet, and actually they weren't a problem, really. They were actually an asset for a lot of people, and obviously it's became a major problem. So I think that is something that can be worked on. I think that thing I'd advocate most is it is a bloody cash flow, and treat it like a cash flow. Clearly, the what is the cash payments you're really going to make, which obviously include inflation. That makes it absolutely key thing. Really focusing on the demography, so you can really see. Don't take the broad brush, get the specifics. And I think where the industry should drive harder is to real data, really looking at the data harder on payments and on returns. Yeah, and it will mean, I think, if you do that, you're going to see that a lot of this stuff in terms of hedging the measure and all this clearly took everybody in the wrong direction, resulted in the need to do some of the LDI kind of stuff, and it will probably fall by the wayside. It's a technique, perfectly reasonable. It isn't where you should be looking. You should be looking at your cash payments, and which again be impacted now by inflation. And you should look at what the returns you're making, not necessarily on a cash flow matched basis, but just on what your assets are knocking out by way of cash. Look at the cash flow. Every other bit of treasury management will have the proper cash flow in it. And I think there's some good work to be done yet from maybe from the consultancy end of the spectrum to actually upgrade modeling, which actually will, I think, on the whole, demonstrate that when you replace actuarial prudence whenever you can with reality, you're better off than you think, which is the way it should be. And I think means that all the debate we have about, there's something that you shouldn't assume is just going to be given off to the life insurer. It's something that can be brought to the party for members and for the sponsor to address intergenerational unfairness and actually provide better pensions for today's employees. Yeah,
absolutely. Henry, do you want to say your final sort of closing remarks? And also next week we've got an interesting guest, I think. But go on, Henry. You do your closing remark, and
then we'll come to the interesting guest. The analogy of LDI as a bridge has been very well rehearsed in the last few days. Some say it's a bridge to buyout. Latterly, John Hamilton said that there was a fractured bridge. Con has described it as if you had a bridge which had systemic faults, why would you, as a structural engineer, keep quiet about it for the last 10 years? And then most recently, I've likened LDI to the bridge between the Crimea and Russia. First of all, it's damaged. Secondly, it can't carry very much in the way of traffic. And thirdly, who the hell wants to go to Russia?
Good point, Henry. Okay. And the guest next week?
Henry, it's to let them get out, not to go in.
There you go. William, thank you very much indeed for today's presentation. It's a very emotional and passionate subject for many people. And actually, I was thinking earlier, if I was a lay trustee, I think I'd have been really scared in the last couple of weeks as a lay trustee, because this stuff is really high end. And I know Guy Opperman, before he left, said, get rid of member nominated trustees, get rid of lay trustees. But maybe there was a few last week that got the message that actually this is serious stuff, and it is serious pounds, shillings and pence. And what Connor said and what you're saying, William, is true. Okay, we got through it, played the long game, I get that, but look at the cash. And for some lay trustees, wow, that is serious stuff, which I think is way above their grade. No disrespect to many of them, but serious stuff. Henry, tell us next week about who we got.
Next week we've got Ben Piggott of Royal Mail, who has been through the whole process of getting his collateral together and buying down his equities and all that stuff. So he's going to give us hopefully a insider's view on what it was like on the other side of the arguments. And very much look forward to seeing him then.
Excellent, thank you. And I appreciate everybody's time this morning. I appreciate William's presentation, and TC, your help with that. That's fantastic. Con, you still got your hand raised. Have you got anything else to say, or should we leave it till next week?
Called my lack of control over the technology.
Okay. Well, I appreciate your input, Con. John, thank you very much indeed. Chris as well. Really appreciate that. I hope you've enjoyed the session. Absolutely fantastic. And let's all do this again next week with the Royal Mail, see what they had to do and see what their experience was. So great to see you all, and enjoy the rest of your day, and peace in the East. And hopefully they can all get over the bridge and get out. So there you go. Cheers, Con.
Thanks all.
Cheers,
Cheers,
William.
bye-bye.
Bye. Bye.
Cheers.